Good morning to all of you. So, in the chapter of accounting ratios, we will start our next ratio, that is solvency ratios. And prior to this, we have covered a ratio that is called liquidity ratios. And why we used to calculate liquidity ratios? Because with the help of liquidity ratios, we are able to know that whether firm is efficient in meeting its short-term obligations or not. Now, next in the solvency ratio, what is actually solvency ratios? So, solvency ratios assess that whether business is in a position to meet its long-term financial obligation as and when they become due. Now, you see in liquidity ratio, what we used to assess short-term financial obligations, and solvency ratio will assess the long-term financial obligations. And when what is long term financial obligations? Obligations to repay the principal amount, obligations to repay interest amount on the loan taken. The loan which are long term loan which will be repayable after a period of 1 year. So in solvency ratio, with the help of many four formulas or four type of ratios are there inside the solvency ratio, and with the help of those ratio, we will see whether the business is efficient or not in meeting its long-term financial obligations as and when they become due. That means once they are due, the business can easily repay the principal amount, easily repay the interest amount. Now, in this solvency ratio, the first type of ratio, it is debt equity ratio, and second is total asset to debt ratio, third is proprietary ratio, and fourth one is interest coverage ratio. So there are four types of solvency ratios. First is debt equity ratio, second is total assets to debt ratio, and third is proprietary ratio, and fourth one is interest coverage ratio. Now let's start with the debt equity ratio. So what is debt equity ratio? So as the name suggests, the debt equity ratio shows the relationship between long term external equities or external debts, or what we call as debts, and internal liabilities, that is shareholders fund. That means it is simply a ratio of debt and equity. This ratio measures the proportion of external funds and shareholders fund invested in the business. That means in the total capital structure, what is the proportion of debts and what is the proportion of equity in the business. So yesterday we have covered this part also, where through balance sheet you are supposed to calculate debts, you are supposed to calculate shareholders fund. So we'll have a just quick review of that one. So if you calculate shareholders fund, what is the formula? Shareholders fund is equal to equity share capital plus preference share capital plus reserve and surplus, and you will deduct if any fictitious assets are there. So fictitious assets example, discount on the issue of debentures or shares, loss on the sale of any fixed assets, any preliminary expenses. These are the examples. In case any fictitious assets will be there, you will be deducting that one from the shareholders fund. And debts means here long term borrowings, long term provisions. So example of long term borrowings will be in debentures or long term bank loan. That the example of debts. And when you add debts to the current liabilities, it will become the total debts. And what is capital employed? It is a sum of shareholders fund and the debts. So by using this format, we will try to calculate all the formulas. So now start with the question. So first question is, calculate debt to equity ratio where equity share capital is 5 lakh, general reserve is 90,000, accumulated profit it is 50,000, 10% debentures it is 1 lakh 30,000, and current liabilities it is 1 lakh. So as we are supposed to calculate the debt equity ratio, So we have to calculate what is the total amount of debts, and debts means long term, not short term, and equity, that is shareholders fund. So all the things are given here. So for the calculation of equity, we will add here, that is share capital plus general reserve plus accumulated profits. So all these three will be a part of equity, and debts will be the 10% debentures, that is 1,30,000. So if we'll add equity share capital plus general reserve plus accumulated profit, will be getting 6,40,000 as equity, and the amount of debts, it is 1,30,000. So you'll be putting in the formula debt equity ratio 1,30,000 divided by 6,40,000. So ratio we are getting as 0.2:1. The next one, that is total assets 2,60,000, total debts 1,80,000, current liabilities 20,000. Calculate debt equity ratio. So in this we don't have the information of equity as well as the debts. We are having the information of total debts, that is it is a sum of debts plus current liabilities. So simply what you will do, in order to calculate the long term debts, because in this total debts it is a sum of long term debts and short term debts, and here short term debt current liability, it is already given. So from total debts you deduct the current liability, you will be getting the debts. Okay, and next is how to calculate the equity. So here total asset, it is already given, and we are knowing the total assets and total liabilities, the value is always same. So from total assets you deduct the value of total debts. That means indirectly what we are doing, from total liabilities we are deducting the total debts. So if we exclude total debts from total liabilities or total assets, what will be remaining? The remaining amount will be equity. So here we are showing equity is equal to total assets minus total debts. So when you are calculating this, 2,60,000 is the value of equity, 1,80,000 total debts, and if you will deduct, you will be getting 80,000 as a value of equity, and long term debts, it is 1,60,000, and put in the formula here, you will be getting 2:1. So 2:1 is an ideal debt equity ratio, just like we are having the ideal current ratio as 2:1, ideal liquid ratio is 1:1. Similarly, ideal debt equity ratio is also 2:1. Now see this question, 10,000 equity shares of rupees 10 each. So here 10,000, it is of no use in the question. It is only representing number of equity shares, here also number of preference shares. So the value of equity share, it is 1 lakh, preference share, it is 50,000, general reserve 45,000, and surplus 20,000, and we are having a debenture valuing rupees 75,000. So you add all these reserves and surplus plus equity share plus share capital. So equity share capital plus preference share capital plus general reserve plus surplus, it will be a part of your equity. And debts, it is already given. So sum all these, 1 lakh plus 50,000 plus 45,000 plus 20,000, that will be your equity. Put in the formula and get the answer. Now see this question, total assets 12 lakhs 50,000, total debts 10 lakhs, current liabilities 5 lakhs. So you have to calculate what? Debts as well as equity. So formula, we are knowing what is debts. Debt is simply difference between the total assets, total debts, and current liabilities. So this is there, total debts minus current liabilities, and equity, total assets minus total debts. So put all the figures here. That means total debts, what is the value of total debts? 10 lakhs. From 10 lakhs you deduct current liabilities 5 lakhs, you will be getting debts as 5 lakhs, and total assets it is 12 lakhs 50,000. From that you deduct total debts 10 lakhs, it will be 2 lakhs 50,000. So put in the formula and see what ratio you are getting. And last one, this one, today's question, capital employed, it is 8 lakhs, shareholders fund 2 lakhs, calculate debt equity ratio. So already equity is given, equity, shareholders fund, net worth, all are same. Only thing you are supposed to calculate is debts. Debt is simple difference of capital employed and shareholders fund. That means debt is equal to 8 lakhs minus 2 lakhs, so the value of debts will be 6 lakhs. That you will put in the formula and see what you are getting.